Hello everyone, welcome back to Boss Economic World. I'm your host, here to peel back the layers of the financial onion without making you cry, well, at least not until we look at the national debt. Today is Saturday, December 13th, 2025. Grab your coffee, or maybe something stronger, because we need to talk about the elephant in the room. Actually, it's not an elephant anymore, it's a T-Rex, and it's currently eating the furniture in the global financial living room. I'm talking about bond yields. Now, I know. Bonds sounds like the most boring topic at a dinner party, right alongside actuarial tables and photos of other people's cats. But stick with me. Because right now, the bond market is flashing a warning signal so bright it's visible from Mars. We are seeing a prolonged period of elevated long-term yields that is ramping up borrowing costs from New York to Tokyo. Why? Because the people who lend money to governments, the Bond Vigilantes, are finally waking up and realizing that the emperor has no clothes, a maxed-out credit card, and a gambling problem. Today, we are going to break down the One Big Beautiful Bill Act, the rumors swirling around the Federal Reserve, the $324 trillion debt mountain, and why a doom loop might be coming to a portfolio near you. Let's get into it. First, let's look at the scoreboard. As of this morning, yields on long-dated debt, we're talking the 10-year and 30-year US Treasuries, are pushing levels we haven't seen since the dark days of 2009. For the uninitiated, let's do a quick Economics 101 refresher. When you buy a government bond, you are lending money to the government. In return, they pay you interest. Price and yield are opposites. Like a seesaw. When people want to buy bonds, the price goes up and the yield goes down. When people are scared or think the government is being reckless, they sell bonds. The price crashes, and the yield spikes. Right now, the yield is spiking. Why? Because investors are demanding extra compensation. They are basically saying, hey Uncle Sam, if you want me to lock up my money with you for 30 years, you need to pay me a premium because I'm not sure your check is going to clear, or if it does, the dollars you pay me back with will be worth as much as monopoly money. This is what we call the term premium. It's the danger money. And right now, the danger money is getting expensive. What's driving this? It's a cocktail of three toxic ingredients. 1. Entrenched budget deficits, governments are spending like drunken sailors, but at least sailors spend their own money. 2. Sticky inflation, prices aren't coming down as fast as promised. 3. The Fed's independence, or rather, the fear that the Federal Reserve is about to become a political puppet. Let's zoom out. This isn't just an American problem, it's a planetary one. According to the Institute of International Finance, global debt hit a record $324 trillion in the first quarter of 2025. To put that in perspective, if you stacked $324 trillion bills, you could reach the moon and back. Well, actually, you'd probably collapse the physics of the universe, but you get the point. It is an incomprehensible amount of money. Who are the worst offenders driving this surge? It's the big three of borrowing: China, France, and Germany. How did we get here? For 15 years, following the 2008 financial crisis, we lived in a fantasy land of zero interest rate policy. Money was free. Governments loaded up on cheap debt. Then, COVID-19 hit, and they doubled down, printing trillions to keep the lights on during lockdowns. It was a giant party. But now the lights are on, the music has stopped, and the bartender is handing us the bill. Central banks, who used to be the designated buyers of all this debt, have flipped the switch. They are now doing quantitative tightening. They are selling the debt back into the market. So, you have governments issuing more debt to pay for deficits, and central banks selling old debt. That is a massive supply glut. And when supply exceeds demand, prices fall, and yields rise. It's simple supply and demand, folks. Now, let's bring it home to the USA. The centerpiece of the current economic anxiety is President Trump's legislative baby, the One Big Beautiful Bill Act. It's a catchy name, I'll give him that. But the math? The math is terrifying. The Congressional Budget Office, the nonpartisan accountants who are the only sober people in Washington, estimates this bill could add $3.4 trillion to the US deficit over the next decade. And that's a conservative estimate. It doesn't fully account for dynamic effects, which as economists speak for stuff we can't predict. The administration argues that tax cuts will pay for themselves through growth. But the bond market isn't buying it. They look at the balance sheet and see red ink as far as the eye can see. This recklessness has consequences. Remember back in May 2025? Moody's ratings finally did what everyone feared: they stripped the US of its last remaining top-tier credit score. This was a psychological blow. It was Moody's saying, we no longer believe the US is the risk-free, gold standard borrower. They cited ballooning national debt and deficits as the reason the US might lose its standing as the preeminent destination for global capital. And what about the tariffs? The administration started enforcing sweeping import tariffs earlier this year. Through November, they raised about $240 billion. Sounds like a lot, right? Here's the reality check: $240 billion is a rounding error when your deficit is in the trillions. It's like trying to bail out the Titanic with a teaspoon. The deficit did unexpectedly narrow slightly for the fiscal year, but bond investors know that tariffs are a one-time sugar hit, not a structural fix. Plus, tariffs are taxes on consumers, which keeps inflation high, which keeps yields high. See the cycle? Now, let's talk about the drama that belongs on a reality TV show. The relationship between the White House and the Federal Reserve. Investors need the Fed to be the adult in the room. The Fed's job is to take away the punch bowl when the party gets too wild. But President Trump has been openly criticizing Fed Chair Jerome Powell, whose term ends in May 2026. The rumor mill is spinning that Kevin Hassett, the director of the White House National Economic Council, is the front-runner to replace Powell. Why does this matter? Hassett is viewed as a dove, someone who prefers lower interest rates and is aligned with Trump's vision of cheap money to juice the economy. If the market believes the next Fed chair will cut rates just to please the president, regardless of inflation data, we have a major problem. It erodes the credibility of the central bank. If investors think the Fed will let inflation run hot to help the government inflate away its debt, they will demand massive yields to hold long-term bonds. They are pricing in the risk that the dollar in 2035 will buy a lot less than the dollar in 2025. This is why the term premia is spiking. It's the market saying, I don't trust the referee anymore. So, why should you, the average citizen or the hard-working professional, care about the yield on a 30-year treasury bond? Because the bond market is the bedrock of the entire financial system. When the bedrock cracks, the house shakes. 1. The cost of living. Long-term treasury yields influence everything. Mortgages. The 30-year fixed mortgage rate tracks the 10-year treasury. When yields spike, mortgage rates spike. The housing market freezes. Auto loans and credit cards. Borrowing becomes more expensive for everyone. Corporate debt. Companies borrow money to expand and hire. When their borrowing costs go up, they hire fewer people or cut jobs. 2. The fiscal vicious cycle. This is the scary part, the doom loop. As yields rise, the government has to pay more interest on its $35+ trillion debt. To pay that interest, they have to borrow more money. Borrowing more money increases the supply of bonds. Increasing the supply lowers the price and raises the yields, which increases the interest costs, which requires more borrowing. It is a death spiral. In the past, Japan acted as a global anchor because their yields were so low, keeping global rates down. That anchor is gone. In the UK, we saw what happens when the bond market revolts. Remember Liz Truss in 2022? Her mini-budget of unfunded tax cuts caused the bond market to vomit. Yields skyrocketed, pension funds almost collapsed, and she was out of office faster than a head of lettuce could rot. Chancellor Rachel Reeves in the UK is currently walking a tightrope, trying to prove she's fiscally responsible while her own party screams for spending. She knows the Bond Vigilantes are watching. Here is the scenario that keeps economists up at night. We have Trump's tariffs, which increased the cost of goods. We have high bond yields, which slows down business and housing. If you mash those two together, you get stagflation, stagnant growth plus high inflation. This is the worst-case scenario for the Fed. If they raise rates to fight inflation, they crush the economy further. If they cut rates to help the economy, inflation explodes. It's a pick-your-poison situation. And with the political pressure on the Fed to cut rates, the market is betting we might get the inflation explodes option. Is this just a blip, or is this the new reality? I recently read a fascinating analysis by Jamie Rush, Tom Orlick, and Stephanie Flanders over at Bloomberg Economics. They argue that we need to stop waiting for rates to go back to 1% or 2%. Those days are dead and buried. They suggest that 10-year Treasury yields of 4.5% to 5.5% could be the new normal. Why? Because the natural rate of interest has risen. Structural forces, demographics, the green energy transition, the rewiring of global supply chains, and the massive debt loads mean that money will fundamentally cost more in the future. In their book, The Price of Money, they wrote, in the years ahead, the natural rate is set to edge higher still. If risks from debt, climate, geopolitics, and technology crystallize, it could rise quite a lot. Folks, look around. The risks are crystallizing. So, to wrap up this episode of Boss Economic World, here is the truth behind the event. The era of free money wasn't free. It was a loan from the future, and the future has arrived to collect. The spike in bond yields is the market's way of disciplining politicians who refuse to budget. Investors are voting with their wallets. They are saying that if politicians lack the ambition or ability to rein in finances, the market will do it for them brutally. What should you do? 1. Deleverage, high rates punish debt. Pay it down if you can. 2. Diversify, the old 60-40 portfolio of stocks and bonds is under stress because bonds are no longer the safe haven they used to be. 3. Watch the Fed, the battle for the next chair in 2026 will determine the value of your dollar for the next decade. The bond market is the smartest person in the room. Right now, it's screaming fire. It might be time to stop ignoring it. I'm Boss Economic World. Analyze the truth, follow the money, and I'll see you in the next episode.